Gopikumar report.
Thank you.
In his familiar soft-spoken tone, the RBI governor delivered a veritable killer blow today. A 50 basis points hike in repo rates, taking it to a historically high 8%. His reasons: the wholesale price index continues to surprise on the upside and global cues aren't helping.
Actual inflation so far has been even higher than expected. In particular, non-food manufactured product inflation has been significantly higher than the average of 4% over the last 6 years. Crude oil prices remain volatile and are a major risk factor. The recent increase in domestic administered fuel prices and the minimum support price for certain food items will also keep inflation under pressure.
Clearly, the governor doesn't expect prices to moderate in a hurry. He has raised the March end inflation forecast to 7% from 6%. And with recent fuel price hikes yet to be passed on and electricity prices likely to be hiked, inflation could hit 10% by September. A slight moderation is likely only thereafter. So, basically, the RBI will persist with inflation baiting, and inflation levels will dictate the governor's next step on the 16th of September.
Going forward, the monetary policy stance will depend on the evolving inflation trajectory, which in turn will be determined by trends in domestic growth and global commodity prices. A change in stance will be motivated by signs of a sustainable downturn in inflation.
But won't this impact growth? Not much, says the governor. He expects FY12 GDP growth to stay at 8% and even seemed okay with moderation. But a bunch of economists believe this overkill on inflation may cost the economy dear.
My sense is that maybe the RBI is underestimating the time it takes for interest rates to impact the economy. It seems as though he's saying, almost with a sort of hint of surprise, that we're not seeing widespread weakness in the economy yet. But as I say, I think it takes a good 12 to 18 months for those effects to come through. And as a result, if I'm right, then we're only at the very early stages of seeing the impact. Growth, I think, is going to soften markedly from here.
Subbarau's comments on the fisc were a new high in forthrightness. He pointed out that fiscal deficit was showing signs of slipping, and higher deficits mean more demand and hence more inflation. He went to the point of saying RBI is being forced to act more because the government is not doing its bit.
The policy actions will reinforce the point that in the absence of complementary policy responses on both demand and supply sides, stronger monetary policy actions are required.
Such inflation targeting has industry worried.
The supply side and the other policy issues are not addressed at the government level, then Reserve Bank is going to use one stick, which is its monetary policy stick, to continue to beat and manage expectations on inflation. I'm not sure whether that will reach the final outcome because it requires an orchestra to make a good music and not one instrument, and therefore I think it's important that it requires a much more concerted effort if we do not want to get into a growth paralysis in India.
The markets showed their anguish and how. The Sensex fell over 300 points, with sectors like autos, real estate, banks and infrastructure, which are bound to see an earnings downgrade, leading the way. Bonds fell too. The 10-year yield jumped to 8.41% and dealers say it could jump to even 8.5%. In Mumbai with Lata Venkatesh, Gopika Gopakumar.
And Finance Minister Pranab Mukherjee welcomed the RBI's aggressive action. He said that the 50 basis points hike will help bring down inflation to a more comfortable level of 67% by the year end.
They wanted to convey a very strong signal to reduce the inflationary pressure, and we shall have to watch that how the market reacts to it and what becomes the ultimate impact of it.
The Finance Minister there reacting to the rate hike. Planning Commission Deputy Chairperson Montek Singh Ahluwalia on his part said that the RBI Governor's hawkish stance was actually the need of the hour.
The Governor has chosen a little more aggressive stance, but I don't think that's improper. You do need to send signals, and if the situation improves, he can reverse the position later. So I think it's bound to be effective in controlling inflation, although I can understand that some people will worry that the impact on the interest rate may be a little too high, but it's a matter of balance, and I don't think there's anything wrong with it.
And staying with this story, borrowers will soon have to write larger EMI checks. Bankers are all set to raise lending rates, and it's not the pressure on margins that's worrying them. Bankers are concerned about a possible rise in bad loans. Gopakumar and Vidhi Godiawala have more.
Bankers were unanimous in their decision to pass on the 0.5 percentage point rate hike signal given by RBI.
The costs go up, impact on interest rates will come now, whether it will be 50, 25, 10. Frankly, we don't know at this stage, but obviously with an increase in costs. And we also have to take into account that the RBI has said that there are demand pressures persisting, and so they want to reduce the pressures. So will the interest rates go up? I would say yes.
They also said short-term deposit rates are more likely to rise.
Deposit rates may not go up so sharply at the long end, 5 years, 10 years, but short-term rate may badhane ki there would be a need to increase.
Higher rates would mean higher costs for banks, but bankers see no substantial margin pressure.
If the cost of deposits are moving up and you've not been able to pass on the entire deposit, the pressure would be there.
Margins will be under pressure in case you don't pass it on. And we said bias is upwards. So there may be very slight pressure, if at all, in consideration that we are a people's bank.
But what's got bankers worried is not margins, but a likelihood of rising loan defaults.
But where exactly we may have problems in NPA is those highly leveraged companies, number 2, small and medium enterprises, where the margins are lower.
In fact, bankers have asked the RBI to change rules in identifying bad loans. They don't want delay in commercial production as a criteria in recognizing NPAs.
We took up with RBI that the NPA identification and NPA classification definition also needs to be revisited. Because today, for many of the projects, whether account is standard or substandard is linked to whether the commercial production date has been achieved. I think that needs to be delinked, and you should look at the ultimate collectability of the debt relative to measured by the security and the cash flow generation.
But the central bank is in no mood to grant this change, though it is open to make concessions for specific cases.
Specific cases as there we can examine, but whatever is our guidelines, they are prudent and there is enough scope. In fact, what we are telling the banks that why they cannot look into that, what will be the appropriate commercial production, and if it is not happening, it gives the risk, and that is quite